How the economic machine works in 30 minutes. The economy works like a simple machine, but many people don't understand it, or they don't agree on how it works, and this has led to a lot of needless economic suffering. I feel a deep sense of responsibility to share my simple but practical economic template. Though it's unconventional, it has helped me to anticipate and to sidestep the global financial crisis, and it has worked well for me for over 30 years. Let's begin. Though the economy might seem complex, it works in a simple, mechanical way. It's made up of a few simple parts and a lot of simple transactions that are repeated over and over again a zillion times. These transactions are above all else driven by human nature, and they create three main forces that drive the economy. Number one, productivity growth. Number two, the short-term debt cycle. And number three, the long-term debt cycle. We'll look at these three forces and how laying them on top of each other creates a good template for tracking economic movements and figuring out what's happening now. Let's start with the simplest part of the economy, transactions. An economy is simply the sum of the transactions that make it up, and a transaction is a very simple thing. You make transactions all the time. Every time you buy something, you create a transaction. Each transaction consists of a buyer exchanging money or credit with a seller for goods, services, or financial assets. Credit spends just like money, so adding together the money spent and the amount of credit spent, you can know the total spending. The total amount of spending drives the economy. If you divide the amount spent by the quantity sold, you get the price. And that's it. That's a transaction. It's the building block of the economic machine. All cycles and all forces in an economy are driven by transactions. So, if we can understand transactions, we can understand the whole economy. A market consists of all the buyers and all the sellers making transactions for the same thing. For example, there is a wheat market, a car market, a stock market, and markets for millions of things. An economy consists of all of the transactions in all of its markets. If you add up the total spending and the total quantity sold in all of the markets, you have everything you need to know to understand the economy. It's just that simple. People, businesses, banks, and governments all engage in transactions the way I just described, exchanging money and credit for goods, services, and financial assets. The biggest buyer and seller is the government, which consists of two important parts: a central government that collects taxes and spends money, and a central bank, which is different from other buyers and sellers because it controls the amount of money and credit in the economy. It does this by influencing interest rates and printing new money. For these reasons, as we'll see, the central bank is an important player in the flow of credit. I want you to pay attention to credit. Credit is the most important part of the economy and probably the least understood. It's the most important part because it's the biggest and most volatile part. Just like buyers and sellers go to the market to make transactions, so do lenders and borrowers. Lenders usually want to make their money into more money, and borrowers usually want to buy something they can't afford, like a house or a car, or they want to invest in something like starting a business. Credit can help both lenders and borrowers get what they want. Borrowers promise to repay the amount they borrow, called principal, plus an additional amount called interest. When interest rates are high, there is less borrowing because it's expensive. When interest rates are low, borrowing increases because it's cheaper. When borrowers promise to repay and lenders believe them, credit is created. Any two people can agree to create credit out of thin air. That seems simple enough, but credit is tricky because it has different names. As soon as credit is created, it immediately turns into debt. Debt is both an asset to the lender and a liability to the borrower. In the future, when the borrower repays the loan plus interest, the asset and the liability disappear and the transaction is settled. So why is credit so important? Because when a borrower receives credit, he is able to increase his spending. And remember, spending drives the economy. This is because one person's spending is another person's income. Think about it. Every dollar you spend, someone else earns, and every dollar you earn, someone else has spent. So when you spend more, someone else earns more. When someone's income rises, it makes lenders more willing to lend him money because now he's more worthy of credit. A credit-worthy borrower has two things: the ability to repay and collateral. Having a lot of income in relation to his debt gives him the ability to repay. In the event that he can't repay, he has valuable assets to use as collateral that can be sold. This makes lenders feel comfortable lending him money. So increased income allows increased borrowing, which allows increased spending. And since one person's spending is another person's income, this leads to more increased borrowing, and so on. This self-reinforcing pattern leads to economic growth and is why we have cycles. In a transaction, you have to give something in order to get something, and how much you get depends on how much you produce. Over time, we learn, and that accumulated knowledge raises our living standards. We call this productivity growth. Those who are inventive and hardworking raise their productivity and their living standards faster than those who are complacent and lazy. But that isn't necessarily true over the short run. Productivity matters most in the long run, but credit matters most in the short run. This is because productivity growth doesn't fluctuate much, so it's not a big driver of economic swings. Debt is, because it allows us to consume more than we produce when we acquire it, and it forces us to consume less than we produce when we have to pay it back. Debt swings occur in two big cycles. One takes about 5 to 8 years, and the other takes about 75 to 100 years. While most people feel the swings, they typically don't see them as cycles because they see them too up close, day by day, week by week. In this chapter, we're going to step back and look at these three big forces and how they interact to make up our experiences. As mentioned, swings around the line are not due to how much innovation or hard work there is. They're primarily due to how much credit there is. Let's for a second imagine an economy without credit. In this economy, the only way I can increase my spending is to increase my income, which requires me to be more productive and do more work. Increased productivity is the only way for growth. Since my spending is another person's income, the economy grows every time I or anyone else is more productive. If we follow the transactions and play this out, we see a progression like the productivity growth line. But because we borrow, we have cycles. This isn't due to any laws or regulations, it's due to human nature and the way that credit works. Think of borrowing as simply a way of pulling spending forward. In order to buy something you can't afford, you need to spend more than you make. To do this, you essentially need to borrow from your future self. In doing so, you create a time in the future that you need to spend less than you make in order to pay it back. It very quickly resembles a cycle. Basically, anytime you borrow, you create a cycle. This is as true for an individual as it is for the economy. This is why understanding credit is so important, because it sets into motion a mechanical, predictable series of events that will happen in the future. This makes credit different from money. Money is what you settle transactions with. When you buy a beer from a bartender with cash, the transaction is settled immediately. But when you buy a beer with credit, it's like starting a bar tab. You're saying you promise to pay in the future. Together, you and the bartender create an asset and a liability. You just created credit out of thin air. It's not until you pay the bar tab later that the asset and the liability disappear, the debt goes away, and the transaction is settled. The reality is that most of what people call money is actually credit. The total amount of credit in the United States is about $50 trillion, and the total amount of money is only about $3 trillion. Remember, in an economy without credit, the only way to increase your spending is to produce more. But in an economy with credit, you can also increase your spending by borrowing. As a result, an economy with credit has more spending and allows incomes to rise faster than productivity over the short run, but not over the long run. Now, don't get me wrong. Credit isn't necessarily something bad that just causes cycles. It's bad when it finances overconsumption that can't be paid back. However, it's good when it efficiently allocates resources and produces income so you can pay back the debt. For example, if you borrow money to buy a big TV, it doesn't generate income for you to pay back the debt. But if you borrow money to, say, buy a tractor, and that tractor lets you harvest more crops and earn more money, then you can pay back your debt and improve your living standards. In an economy with credit, we can follow the transactions and see how credit creates growth. Let me give you an example. Suppose you earn $100,000 a year and have no debt. You are creditworthy enough to borrow $10,000, say on a credit card. So you can spend $110,000 even though you only earn $100,000. Since your spending is another person's income, someone is earning $110,000. The person earning $110,000 with no debt can borrow $11,000, so he can spend $121,000, even though he has only earned $110,000. His spending is another person's income, and by following the transactions, we can begin to see how this process works in a self-reinforcing pattern. But remember, borrowing creates cycles, and if the cycle goes up, it eventually needs to come down. This leads us into the short-term debt cycle. As economic activity increases, we see an expansion, the first phase of the short-term debt cycle. Spending continues to increase and prices start to rise. This happens because the increase in spending is fueled by credit, which can be created instantly out of thin air. When the amount of spending and incomes grow faster than the production of goods, prices rise. When prices rise, we call this inflation. The central bank doesn't want too much inflation because it causes problems. Seeing prices rise, it raises interest rates. With higher interest rates, fewer people can afford to borrow money, and the cost of existing debts rises. Think about this as the monthly payments on your credit card going up. Because people borrow less and have higher debt repayments, they have less money left over to spend, so spending slows. And since one person's spending is another person's income, incomes drop, and so on and so forth. When people spend less, prices go down. We call this deflation. Economic activity decreases, and we have a recession. If the recession becomes too severe and inflation is no longer a problem, the central bank will lower interest rates to cause everything to pick up again. With low interest rates, debt repayments are reduced and borrowing and spending pick up, and we see another expansion. As you can see, the economy works like a machine. In the short-term debt cycle, spending is constrained only by the willingness of lenders and borrowers to provide and receive credit. When credit is easily available, there's an economic expansion. When credit isn't easily available, there's a recession. And note that this cycle is controlled primarily by the central bank. The short-term debt cycle typically lasts 5 to 8 years and happens over and over again for decades. But notice that the bottom and top of each cycle finish with more growth than the previous cycle and with more debt. Why? Because people push it. They have an inclination to borrow and spend more instead of paying back debt. It's human nature. Because of this, over long periods of time, debts rise faster than incomes, creating the long-term debt cycle. Despite people becoming more indebted, lenders even more freely extend credit. Why? Because everyone thinks things are going great. People are just focused on what's been happening lately. And what's been happening lately? Incomes have been rising. Asset values are going up. The stock market roars. It's a boom. It pays to buy goods, services, and financial assets with borrowed money. When people do a lot of that, we call it a bubble. So even though debts have been growing, incomes have been growing nearly as fast to offset them. Let's call the ratio of debt to income the debt burden. So long as incomes continue to rise, the debt burden stays manageable. At the same time, asset values soar. People borrow huge amounts of money to buy assets as investments, causing their prices to rise even higher. People feel wealthy. So even with the accumulation of lots of debt, rising incomes and asset values help borrowers remain creditworthy for a long time. But this obviously cannot continue forever. And it doesn't. Over decades, debt burdens slowly increase, creating larger and larger debt repayments. At some point, debt repayments start growing faster than incomes, forcing people to cut back on their spending. And since one person's spending is another person's income, incomes begin to go down, which makes people less creditworthy, causing borrowing to go down. Debt repayments continue to rise, which makes spending drop even further. And the cycle reverses itself. This is the long-term debt peak. Debt burdens have simply become too big. For the United States, Europe, and much of the rest of the world, this happened in 2008. It happened for the same reason it happened in Japan in 1989 and in the United States back in 1929. Now the economy begins deleveraging. In a deleveraging, people cut spending, incomes fall, credit disappears, asset prices drop, banks get squeezed, the stock market crashes, social tensions rise, and the whole thing starts to feed on itself the other way. As incomes fall and debt repayments rise, borrowers get squeezed. No longer creditworthy, credit dries up, and borrowers can no longer borrow enough money to make their debt repayments. Scrambling to fill this hole, borrowers are forced to sell assets. The rush to sell assets floods the market at the same time as spending falls. This is when the stock market collapses, the real estate market tanks, and banks get into trouble. As asset prices drop, the value of the collateral borrowers can put up drops. This makes borrowers even less creditworthy. People feel poor. Credit rapidly disappears. Less spending, less income, less wealth, less credit, less borrowing, and so on. It's a vicious cycle. This appears similar to a recession, but the difference here is that interest rates can't be lowered to save the day. In a recession, lowering interest rates works to stimulate borrowing. However, in a deleveraging, lowering interest rates doesn't work because interest rates are already low and soon hit 0%, so the stimulation ends. Interest rates in the United States hit 0% during the deleveraging of the 1930s and again in 2008. The difference between a recession and a deleveraging is that in a deleveraging, borrowers' debt burdens have simply gotten too big and can't be relieved by lowering interest rates. Lenders realize that debts have become too large to ever be fully paid back. Borrowers have lost their ability to repay and their collateral has lost value. They feel crippled by the debt. They don't even want more. Lenders stop lending, borrowers stop borrowing. Think of the economy as being not creditworthy, just like an individual. So what do you do about a deleveraging? The problem is debt burdens are too high and they must come down. There are 4 ways this can happen. 1. People, businesses, and governments cut their spending. 2. Debts are reduced through defaults and restructurings. 3. Wealth is redistributed from the haves to the have-nots. And finally, 4. The central bank prints new money. These 4 ways have happened in every deleveraging in modern history. Usually, spending is cut first. As we just saw, people, businesses, and even governments tighten their belts and cut their spending so that they can pay down their debt. This is often referred to as austerity. When borrowers stop taking on new debts and start paying down old debts, you might expect the debt burden to decrease. But the opposite happens. Because spending is cut, and one man's spending is another man's income, it causes incomes to fall. They fall faster than debts are repaid, and the debt burden actually gets worse. As we've seen, this cut in spending is deflationary and painful. Businesses are forced to cut costs, which means less jobs and higher unemployment. This leads to the next step. Debts must be reduced. Many borrowers find themselves unable to repay their loans, and a borrower's debts are a lender's assets. When a borrower doesn't repay the bank, people get nervous that the bank won't be able to repay them, so they rush to withdraw their money from the bank. Banks get squeezed, and people, businesses, and banks default on their debts. This severe economic contraction is a depression. A big part of a depression is people discovering much of what they thought was their wealth isn't really there. Let's go back to the bar. When you bought a beer and put it on a bar tab, you promised to repay the bartender. Your promise became an asset of the bartender. But if you break your promise, if you don't pay him back and essentially default on your bar tab, then the asset he has isn't really worth anything. It has basically disappeared. Many lenders don't want their assets to disappear and agree to debt restructuring. Debt restructuring means lenders get paid back less, or get paid back over a longer time frame, or at a lower interest rate than was first agreed. Somehow, a contract is broken in a way that reduces debt. Lenders would rather have a little of something than all of nothing. Even though debt disappears, debt restructuring causes income and asset values to disappear faster, so the debt burden continues to get worse. Like cutting spending, debt reduction is also painful and deflationary. All of this impacts the central government because lower incomes and less employment means the government collects fewer taxes. At the same time, it needs to increase its spending because unemployment has risen. Many of the unemployed have inadequate savings and need financial support from the government. Additionally, governments create stimulus plans and increase their spending to make up for the decrease in the economy. Governments' budget deficits explode into deleveraging because they spend more than they earn in taxes. This is what's happening when you hear about the budget deficit on the news. To fund their deficits, governments need to either raise taxes or borrow money. But with incomes falling and so many unemployed, who is the money going to come from? The rich. Since governments need more money and since wealth is heavily concentrated in the hands of a small percentage of the people, governments naturally raise taxes on the wealthy, which facilitates a redistribution of wealth in the economy from the haves to the have-nots. The have-nots who are suffering begin to resent the wealthy haves. The wealthy haves, being squeezed by the weak economy, falling asset prices, and higher taxes, begin to resent the have-nots. If the depression continues, social disorder can break out. Not only do tensions rise within countries, they can rise between countries, especially debtor and creditor countries. This situation can lead to political change that can sometimes be extreme. In the 1930s, this led to Hitler coming to power, war in Europe, and depression in the United States. Pressure to do something to end the depression increases. Remember, most of what people thought was money was actually credit. So when credit disappears, people don't have enough money. People are desperate for money, and you remember who can print money? The central bank can. Having already lowered its interest rates to nearly zero, it's forced to print money. Unlike cutting spending, debt reduction, and wealth redistribution, printing money is inflationary and stimulative. Inevitably, the central bank prints new money out of thin air and uses it to buy financial assets and government bonds. It happened in the United States during the Great Depression, and again in 2008 when the United States Central Bank, the Federal Reserve, printed over $2 trillion. Other central banks around the world that could printed a lot of money too. By buying financial assets with this money, it helps drive up asset prices, which makes people more creditworthy. However, this only helps those who own financial assets. You see, the central bank can print money, but it can only buy financial assets. The central government, on the other hand, can buy goods and services and put money in the hands of the people, but it can't print money. So in order to stimulate the economy, the two must cooperate. By buying government bonds, the central bank essentially lends money to the government, allowing it to run a deficit and increase spending on goods and services through its stimulus programs and unemployment benefits. This increases people's income as well as the government's debt. However, it will lower the economy's total debt burden. This is a very risky time. Policymakers need to balance the four ways that debt burdens come down. The deflationary ways need to balance with the inflationary ways in order to maintain stability. If balanced correctly, there can be a beautiful deleveraging. You see, a deleveraging can be ugly or it can be beautiful. How can a deleveraging be beautiful? Even though a deleveraging is a difficult situation, handling a difficult situation in the best possible way is beautiful. A lot more beautiful than the debt-fueled, unbalanced excesses of the leveraging phase. In a beautiful deleveraging, debts decline relative to income, real economic growth is positive, and inflation isn't a problem. It is achieved by having the right balance. The right balance requires a certain mix of cutting spending, reducing debt, transferring wealth, and printing money so that economic and social stability can be maintained. People ask if printing money will raise inflation. It won't if it offsets falling credit. Remember, spending is what matters. A dollar of spending paid for with money has the same effect on price as a dollar of spending paid for with credit. By printing money, the central bank can make up for the disappearance of credit with an increase in the amount of money. In order to turn things around, the central bank needs to not only pump up income growth, but get the rate of income growth higher than the rate of interest on the accumulated debt. So what do I mean by that? Basically, income needs to grow faster than debt grows. For example, let's assume that a country going through a deleveraging has a debt-to-income ratio of 100%. That means that the amount of debt it has is the same as the amount of income the entire country makes in a year. Now think about the interest rate on that debt. Let's say it's 2%. If debt is growing at 2% because of that interest rate, and income is only growing at around 1%, you will never reduce the debt burden. You need to print enough money to get the rate of income growth above the rate of interest. However, printing money could easily be abused because it's so easy to do and people prefer it to the alternatives. The key is to avoid printing too much money and causing unacceptably high inflation the way Germany did during its deleveraging in the 1920s. If policymakers achieve the right balance, a deleveraging isn't so dramatic. Growth is slow, but debt burdens go down. That's a beautiful deleveraging. When incomes begin to rise, borrowers begin to appear more creditworthy. And when borrowers appear more creditworthy, lenders begin to lend money again. Debt burdens finally begin to fall. Able to borrow money, people can spend more. Eventually, the economy begins to grow again, leading to the reflation phase of the long-term debt cycle. Though the deleveraging process can be horrible if handled badly, if handled well, it will eventually fix the problem. It takes roughly a decade or more for debt burdens to fall and economic activity to get back to normal, hence the term lost decade. In closing, of course, the economy is a little bit more complicated than this template suggests. However, laying the short-term debt cycle on top of the long-term debt cycle and then laying both of them on top of the productivity growth line gives a reasonably good template for seeing where we've been, where we are now, and where we're probably headed. So, in summary, there are 3 rules of thumb that I'd like you to take away from this. First, don't have debt rise faster than income, because your debt burdens will eventually crush you. Second, don't have income rise faster than productivity, because you'll eventually become uncompetitive. And third, do all that you can to raise your productivity, because in the long run, that's what matters most. This is simple advice for you, and it's simple advice for policymakers. You might be surprised, but most people, including most policymakers, don't pay enough attention to this. This template has worked for me, and I hope it will work for you. Thank you.
I don't even know what they are.
In that case, it might be a good idea to get a little information with a fellow who owns and operates a company that makes and sells oil drums. Each year, customers buy more and more from our because he makes a better oil drum than his competitors. One day, customers demand more oil drums than the owner can produce. He figures it will take about $3 million to do the job. So he decides to form a corporation to sell shares in his business to raise the capital he needs. First, the owner goes to the state government to get a corporation charter and permit to sell shares in this business. Next, our friend goes to an investment banker and shows him the record of the oil drum manufacturing company's past performance and plans for expansion. The investment banker decides to help our friend sell shares in the corporation to raise the $3 million. However, before any shares in the corporation can be sold, certain information must be filed with the Securities and Exchange Commission in Washington. The investment banker and the owner must swear that the information they file contains nothing but the truth. Registration with the SEC does not imply that the government approves the stock issue as a good investment, but only assures the public the material statements about the stock issue are false. Punishment will be according to the law. After SEC registration is effective, the investment banker pays the owner $3 million in exchange for a certain number of shares in the Oil Drum Manufacturing Corporation. The investment banker sells shares of the common stock to people at a price of $3 million investment and shows a profit for his services in selling the stock. Money received from the sale of shares in the business builds a new and better plant, which produces more and better oil drums. The people who bought common stock own proportionate shares in the corporation, tools, equipment, and all of its assets. Common stockholders elect the directors of the corporation. Directors represent the stock and are responsible for the way the business is run. Directors determine the amount of dividends, if any, to be paid out of earnings to the stockholders. Naturally, when stockholders invest in a business, they hope to receive dividends to help pay for necessities of life. Within a few short years, an increasing demand for the company's product poses a friend. How can he fill all the orders? He will have to build more plants and buy more tools to increase production of oil drums. It will take about $20 million to do the job. One way to get this additional capital is to sell more stock to many more people. So the Oil Drum Manufacturing Corporation votes to send its president to the New York Stock Exchange to see if their common stock can qualify for listing. The corporation wants to list its securities on the exchange so that the additional stock they need to sell will be more attractive to investors all over the nation. Securities listed on the New York Stock Exchange can be sold for cash any time in this national marketplace. Each year, inquire about listing their securities.
but only those which can pass a thorough examination as to their financial health are accepted.
Calling the President of the Oil Drum Manufacturing Corporation. Calling the President of the Oil Drum Manufacturing Corporation. Report to Examination Room B. Attention all members of the Stock List Department. Report to Examination Room B.
The Stock List Department examines the qualifications of corporations to be listed on the New York Stock Exchange. The corporation must have substantial assets in plants, tools, equipment, and cash. There must be a broad distribution of its shares among a large number of stockholders. The corporation must show successful management and sales records and annual net earnings at the time of listing of at least $1 million. The proposed stock issue must meet federal, state, and New York Stock Exchange regulations. The corporation must agree to report to its stockholders at frequent intervals. If the examination by the Stock List Department indicates the corporation meets minimum requirements of the exchange at the time of the examination, the corporation's application for listing is recommended. The Board of Governors of the New York Stock Exchange finally approves the application and sees that it is made public.
Extra, read all about it.
Now that the Oil Drum Manufacturing Corporation stock is listed, its name is abbreviated for use on the ticker tape. Each time ODM stock or any other stock listed on the exchange is bought or sold, the ticker tape flashes all over the nation the price and number of shares traded. A buyer in Colorado wants to purchase some ODM stock. The buyer's broker in Colorado sees that the last ODM transaction was at $10 a share. The buyer could buy from 1 to 99 shares, which would be known as an odd lot. But a Colorado friend decides to invest in 100 shares, known as a round lot. The Colorado broker wires the order to his New York office. The buy order is telephoned to the floor of the New York Stock Exchange. It is given to the firm's floor partner, who becomes the representative of the buyer in Colorado. The floor partner goes to the post where ODM stock is traded. The representative of the buyer in Colorado bids $10 a share for 100 shares. But at the moment, there is no stock offered for sale at this price. In the meantime, however, in Maine, an ODM stockholder who needs cash decides to sell his 100 shares if he gets $10 a share. The Maine broker wires the sell order to his firm's representative on the floor of the New York Stock Exchange. This firm's floor partner, representing the seller in Maine, offers to sell 100 shares of ODM stock at $10 a share. The price of $10 a share is mutually acceptable and the transaction is made. Like the cowboy in Colorado and the fisherman in Maine, investors all over the country use the facilities of brokers who are members of the New York Stock Exchange whenever they want to buy or sell stock of companies listed on this national market. Yesterday's savings financed the miraculous growth of our railroads, automobiles, airplanes, farm machinery, communications, electric light and power, textiles, and countless other industries contributing to a more enjoyable life. If a part of our savings continue to flow into industry, American labor, management, and capital can continue to build new tools and plants. Industrial expansion creates jobs for hundreds of thousands of young people who must find employment each year. A growing capacity to produce things which make life better in peacetime can be our greatest protection in time of war. When danger threatens, we can convert industry to produce the things we need to defend ourselves. Common stock investments have helped to make our country prosperous and powerful. Owning a share in American industry is like owning a share in the future of our nation. But remember, John Q, there is a risk as well as an advantage in owning any kind of property. So get the facts before you put your money to work.
Asset class is a term that describes groups of securities that act similarly in the marketplace. There are several different asset classes, but for individual investors, the most important are equities, otherwise known as stocks and shares, and bonds, which are often divided into government bonds and corporate bonds. When you buy equities, you are literally buying part of a business and becoming a co-owner or shareholder of that particular firm. The returns you get come in two forms. First, any increase in the share price, making your investment more valuable, and secondly, dividends, which are your share of the profits the business makes. But if the firm goes bankrupt, as a shareholder, you're close to the end of the queue when it comes to being repaid. When you buy bonds, however, you're lending money, either to a government agency if it's a government bond, or to a business in the case of corporate bonds. Your returns come in the form of the interest you receive on your loan. If the business or agency defaults on its bond, you'll be a bit closer to the front of the queue to be paid from any capital remaining. Equities are considered riskier than bonds, but on the other hand, they generally deliver higher returns over time. So although you should expect share prices to be volatile at times, equities should, in most cases, form the largest part of a long-term investment portfolio, especially for younger investors. However, if you put too much into equities, you run the risk that your portfolio could fall in value more than you feel comfortable with. So it makes sense to dampen the portfolio volatility with bonds. This is why, the older you are, the greater the proportion of bonds in your portfolio should be, because you have less time remaining to make up the potential shortfall from share losses. The third main asset class is cash. People usually invest in cash via savings accounts or so-called money market funds. Cash is considered to be the safest asset class of all, as it's unlikely, although not impossible, that you will lose any money. The downside to this safety is that over the long term, cash usually delivers smaller returns than bonds, and considerably smaller returns than equities. Cash also carries the risk of having its purchasing power eroded by inflation. In reality, therefore, cash is for savers rather than investors. Finally, there are alternative investments. They all have their attractions and disadvantages. You may want to include cash or alternatives or both in your portfolio, but the two main asset classes you should focus on are equities and bonds.
There are two basic and distinctly different ways to analyze a stock: technical analysis and fundamental analysis. Fundamental analysts believe the market price of a stock doesn't always match the true value of the company that stock represents. Technical analysts believe that the fundamental elements of a stock's value are already accounted for in a stock's price, that prices move in trends, and that historical patterns in the market and in stock prices tend to repeat. To understand the difference, imagine a fundamental analyst, Tom, and a technical analyst, Joe, at a shopping mall trying to decide which store to invest in. Tom goes into each store, studies the product being sold, the layout, the company's financial statements, and then decides whether to buy that company's stock. Tom is looking for the store with the best fundamentals, things like a good product, responsible management, and so on. Joe sits on a bench in the mall and pulls out his laptop so that he can check the stock charts for the various companies. Joe looks to see which company has been performing the best based on the price of its stock, and then looks for patterns that indicate a store with a strong upward trend. In this case, Joe does not consider the store's products or its financial situation, but instead assumes that these fundamental factors are already factored into its current share price. In fact, Joe doesn't even need to be in the mall to make his choice. Tom will base his decision on the company itself and his belief that it is, or soon will be, worth more than its stock price suggests. Joe will buy a stock because historical trends suggest the price is likely to go up, not because of anything he sees in the company itself. In the end, Tom and Joe may choose to invest in the same store, but their reasons for investing will be very different.
Going all the way back to 1917, one share of S&P 500 you could have bought for around $10. PE ratio of the market was around 6.3, which is pretty good. It would be equivalent to 15% earning yield. There was some volatility and there was some declines of around 10 to 15%. Those are called corrections. From 1917 until 1929, market increased from low $10 to $34. That would be 240% increased. PE ratio also increased unsurprisingly from 6.3 to 18, but it made market quite expensive and it would reduce your earning yields. Unsurprisingly, this is when market experienced the biggest decline in the history. It is still the biggest decline to the current date. On the Black Tuesday, 1929, market dropped from $34 all the way to $4. That's insane. Almost 90% drop in the market. PE ratio dropped to low 13. The entire economy collapsed. The Great Depression began. Banks started closing down. People were not able to withdraw any funds that they had. Some of them start jumping out of the windows and killing themselves. After 3 years of bear market, economy began to recover slowly, going from $4 per share in 1932 all the way to $16 in 1937. That would be 300% increase. Since then, everything went downhill once again, mainly because disturbing events were happening around the world, led to the World War II, which began in 1939. Hitler invaded Czechoslovakia and war began. Market dropped from $16 all the way to $10. Not as bad as previous drop, but still 40% decline. Stock market continued to decline until 1942. This is when Pearl Harbor was attacked by Japanese. After this disturbing event, market had some small rally until 1946. It increased from $9 to $18. That's a 100% increase. At that time, no one really thought that this is possible. Market would increase during the second half of the World War II, which is quite astonishing. It had some corrections and moved sideways for almost 5 years until it gained more momentum. From 1948, trading for around $18, it increased all the way to $50 at 1956. That would be 180% increase. While violent events continued to happen around the world, such as USSR exploded first atomic bomb in 1949 and Korean War in early 1950s, stock market was sensitive to those events, but it continued to go up and up and up. With the stock market rally, PE ratio increased as well, from 7 in 1950 all the way to 13 in 1956, which means stocks were cheap in 1950s and became more expensive in 1956. Since 1956, we had an upward trend with some correction on the way. Market decreased by 10 to 15% 3 times or so, but in general it increased from $40 at 1958 all the way to $120 at 1973. That would be 200% increase. Some experts believe, such as Peter Schiff, that it was the biggest and dumbest mistake to do in the stock market history. You're welcome, Peter Schiff, for free publicity. Because of the skyrocketing inflation, which would drop US dollar purchasing power, while other believes that he did the right thing to scale US and global economy with proper trading methods. Nevertheless, when Nixon resigned, market dropped from $120 all the way to $60. That's another bear market and 50% decline, which happened in 1975. The PE ratio also dropped from 18 at 1973 all the way to 8 at 1975. 2 years later, market quickly bounced back to around $100 range and PE ratio increased into mid-11. Since then, we enter into the biggest bull market in the history. Well, at least at that time. Market increased from $100 all the way to $350 at 1987. That would be 250% increase. But not everything looked so great. Black Monday, October 19, 1987. Stock market around the world crashed. The crash began in Hong Kong and spread to West Europe, hitting United States after other markets had already sustained significant declines. Stock market dropped more than 22% in a single day. This is the biggest decline of a single day in the stock market history. After a dark night, there is a bright day after that. Stock market recovered and continued to rally. By the end of 1998, it increased all the way to $1,200. Going from $100 all the way to $1,200 in 2 decades, that would be 1,100% return on your investment. Despite the Black Monday, it was definitely the smoothest rally in the stock market history until that date. The PE ratio also increased from 1978, which was at 8, and it reached 25 at 1998, which means the stock market was quite expensive or very expensive. Let's move on to probably the most familiar and most memorable 2 decades in our lives. Well, at least in my life. Why most memorable? Because of recency bias? Well, maybe. Or maybe because I'm not that old. Well, at least I'm not. At 2000s, PE ratio was at freaking 46. That's definitely the highest PE ratio we have ever seen in the history. It was this expensive for a reason, and the reason was a dot-com bubble in early 2000s. Market dropped from $1,500 to about $800. That would be almost 50% decline. PE ratio dropped from 46 all the way to 20s. Since 2003, market slightly recovered and increased back to $1,500 in early 2008. That's almost 100% increase. In that time, literally anybody could have received a mortgage on a house, even if you are broke and you cannot afford it. Even your dog could have received a mortgage loan. Banks were gathering those shit subprime mortgages into a bond and selling them immediately to other banks, mostly outside of United States. So they transfer their liability to someone else's instantly, while they are able to keep the balance sheet clean. They thought that they discovered a perfect way to make money without risk, until those bonds full of subprime mortgages add up and other party was not able to pay those liabilities, and everything eventually collapsed. Banks were not the only parties to blame. Another whistleblowers were responsible for all that chaos that happened in 2008 are credit rating agencies such as Moody's and S&P. They gave AAA ratings to shit bonds full of subprime mortgages that were not even triple C's. After the housing bubble crashed, they simply stated, "Our ratings is just our opinions." Oh well, I guess nobody will believe you this time. PE ratio was at staggering high. It was more than 70. Are you freaking kidding me? Was this even possible? And of course, stock market crashed. It dropped from $1,500 all the way to $750. That would be 50% drop. PE ratio dropped as well to 20s. Since then, we had smooth ride until the current date. Stock market increased by 250% since early 2000s. Current PE ratio of S&P 500 is 22. Makes it S&P 500 quite expensive, at least in my opinion. That's slight less than 5% earning yield. Not too sure if you are satisfied with 5%, but definitely not me. So, the question of the day, what did we learn from 100 years of history in the stock market? Please leave your comment in the section below, but I'm going to state my 4 principles that I have learned from that data. Number 1. It is probably not the best idea to enter into the market when PE ratio is very high. Personally, I would not enter into the market if PE ratio is more than 20. However, if you are a long-term holder, it would be a mistake to leave the market regardless how high PE is. Number 2. Market is an incredible compounding machine. An average compounding rate is approximately 10% per year. If you would invest $10,000 into S&P 500 100 years ago, hopefully you are not that old, now you would have $2.7 million US. Number 3. Market goes down sometimes, but it always comes back. We have been through many different wars and crises, and there was never a time when market did not come back.
How to buy your first share. If you want to invest in the stock market, it's essential to know how to buy stocks, and that's what we're going to show you today. Stick with us and you'll see how easy it is to buy shares in a company with a step-by-step example. Let's start by going through the basics of how stock trading works. One essential thing you should know is that stocks, shares, and equities mean pretty much the same thing. Shares of public companies are traded on a stock exchange. Some of the most popular stock exchanges are the New York Stock Exchange, NYSE, NASDAQ, and the London Stock Exchange, LSE. A stock exchange is a type of public marketplace for shares, and as with any marketplace, there are buyers and sellers. When a buyer and a seller agree on a price, a deal is done. Here's a high-level view of how it works. When someone wants to sell a share, they submit the price at which they are willing to sell it on the exchange. Buyers do the same. They submit the price at which they want to buy a particular stock. When the lowest selling price meets the highest buying price, a deal is done. This process is fully automated and could happen thousands of times per second for popular stocks, as there are many investors who trade them. The quotes that you see for a certain stock are the prices available for an immediate deal. In order to access a stock exchange, you need a stockbroker who executes deals for you on your behalf. Trading 212, which pioneered zero commission investing in the UK and Europe, makes the whole process as easy as shopping for groceries online. Gone are the days when you had to visit a branch, fill in endless paperwork, and deal with hard-to-use trading platforms straight from the 90s. So let's say you want to buy shares from one of the 2,000 plus companies available on Trading 212. First, get the app from the App Store and open a free Practice Invest account. This shouldn't take more than 2 minutes. In the app, at the very top, you'll see your available balance. This is your money available to invest. Directly below, you'll find lists of shares which you can customize. If you're looking for a specific stock, you can search for it. Let's find National Grid. Click on the magnifying glass, type in National Grid, and there it is. The live price for National Grid in our example right now is 889.4p. It's moving up and down all the time as new trades go through on the London Stock Exchange. The main things to consider when you're buying shares are which company, what price, and how many shares you want to buy. We've already decided to buy National Grid, and we can see the current price. Now we need to decide how many shares we want to buy. This depends on how much money we want to invest. If we want to invest £150 and the price of the stock is £10, we'll have to buy 15 shares. That's £150 divided by £10. Deciding how much to invest in one particular stock depends on your strategy and your risk appetite. As a rule of thumb, it's better not to invest all your money in one stock, or not put all your eggs in one basket, so to speak. But we'll talk about investing strategies, portfolio management, and risk in other videos. So we decided to invest around £150, which in the case of National Grid is 15 shares. Let's click Buy. Set the number of shares to 15 and then tap on Review Order. Here we can make a final check on our order before sending it for execution. If it's okay, tap on Send Buy Order. We get a confirmation saying, Order executed. You bought 15 shares of National Grid at a price of 889.4p. And that's it. The shares are now yours and you own a piece of the company. You can see the exact cost, which is 15 shares multiplied by £8.894, and that equals £133.41. And here's the amazing part. When you invest with Trading 212, there's no commission or fees whatsoever, while other brokers would charge a commission of up to £12 per trade. If you want to see what's going on with your investments, you can go to the Portfolio tab, where you will find its total value and all the stocks that you own. There's also an overview of the proportion of each stock from your portfolio. Tapping it will display the values in percentage. We suggest you play with your free practice account until you feel comfortable enough to invest real money. Feel free to ask us anything in the comments, and don't forget to like, subscribe and hit the notification bell so you're among the first to know when we upload a new video.
Are you there?
Hi.
Hi. Thank you so much
You
for
see
being
me?
here, Ray. I see you. I see you. You look great. Thank you so much for being here. We really appreciate it.
My pleasure.
Okay, so lay it on us, Ray. How bad is it? How worried should we be?
Well, I think you could look at this like a tsunami that's hit, the virus itself and the social distancing, and then what are the consequences in terms of the wreckage when you look at it. And I think you have to think of that as incomes and balance sheets, you know. So it was a tremendous income hit, and then the balance sheets losses, and who has what savings and so on. And then how is that dealt with? And in order to understand that, you have to realize that there are these holes in income and the holes in the balance sheets. And then you have to realize that there is the production of money and credit. And who produces that money and credit? Okay, the money and credit comes in different flavors. There is US dollar money and credit. There is euro dollar money and credit. And so when you look at the world and you're seeing a situation that is the same as existed really in the 1930 to 45 period, in that now we're seeing the production of a lot of debt, a lot of borrowing by the government. We're seeing zero interest rates, and not the traditional kind of monetary policy, but the producing of a lot of money and credit. So the Federal Reserve is buying the Treasury's debt, and the Treasury is getting that money to mostly Americans in some imperfect but remarkably large way. And the Europeans are doing the same in their way. That bank is a smaller bank because the world lives with about 70% dollars and only a small percent euro, and they will produce theirs for theirs. And there aren't many banks around the world. And so the rest of the world is going to have gaps, holes that won't be filled. So if you think about that and you say, American printing of money and the borrowing will leave us with a lot of debt and monetization. That's something interesting to talk about, and we need to talk about that. Who will pay these bills, and how will that be shared will be something we need to talk about. But you will know that you will get that money, and that the Europeans will get their versions of that money. But we are in a new world, and that world is most similar to the 1930 to 45 world, and a lot of the world will not get that money and credit. So there'll be a big differentiation as to which entities benefit and which entities don't. And there'll be a big collaboration as to how we will deal with that bill and who will end up with what. A big question of wealth distribution and all of that. So that's the big thing that's going to be happening.
How confident are you that some of that collaboration can happen right now?
We're now at one of those defining moments that I've seen repeatedly. The 1930 to 45 period, if you go back in history, there's nothing new to this. And it's a defining moment in terms of how people are with each other. So when you look at it, will people come together? Or when it comes down to it, really, will there be a taking care of oneself? And what does that define? And how will that go? That'll be, I think, a defining moment. So I look at these histories. If I can take a minute, I'd like to just paint a template for you that takes us, over the last 1,000 years, the things that have happened over and over again. There is one pattern that I'd like to convey. May I take a moment and do that?
Absolutely.
There are 4 things that are the driving forces of our economy and our lifestyle and wealth. And the first and most powerful is productivity, which comes from people learning and inventing and doing things well, just as Marco described. Okay? And it grows slowly. 1 or 2 or 3% a year, it grows slowly, and it's not volatile because knowledge isn't volatile, but it grows, and that raises our living standards over a period of time. Then there's a short-term debt cycle. The short-term debt cycle is, recessions and expansions and booms and recessions, that they last about 8-10 years. And then there's a long-term debt cycle. And that long-term debt cycle, which goes on about once every 50 to 75 years, is when you begin a new type of money and a new type of credit. That began in 1945. The New World Order, at the end of World War II, and with the Bretton Woods monetary system, created a new monetary system in 1945, a new money. So they wiped out pretty much the old money, or they largely disposed of it, and they began anew, and that's the New World Order, which was the American World Order, and we have seen it, and still 70% of the money and credit that exists in the economy is running by dollars. And what you have traditionally is the breakdown. And then the fourth influence is politics. And politics is largely how we deal with each other. And there's internal politics and there's external politics. The internal politics is, how do you deal with the wealth gap? How do you deal with the values gap? Do you have a common mission? Do we have an American dream that we can agree on and that we're pursuing that together? Or do you fight over wealth and so on? And so when you look at history, that's what revolutions are in their various ways. And there's always a revolution in one of these. Sometimes those are peaceful revolutions, and so sometimes they're disruptive. But it's a wealth shift that needs to take place. So the Roosevelt shifted policies and changed taxes and so on in that way. And then in other countries, there was the turning over democracy. Hitler came to power because of that gap. So how people deal with each other internally. There's also external politics. So that politics means between countries. And you have a situation when there's a rising power challenging existing power. There is competition and there is a risk of war. And so how they deal with each other, so that whether there's a greater good or whether they are fighting with each other, is the defining moment. There are always stress tests, these big stress tests that come along once every 75 years. And when they happen, and this is a stress test. And I think that what you're going to see is as how we deal with each other. There's enough wealth to go around, but what do you do when you're outside the ring of support, let's say of the US dollar? And what is that going to be like for those entities? Or if you're within the ring of support, how will that bill be divided? And how will we be with each other? I think we're going to have to reconsider who has what is it about education and so on. So that's what we're in, I think.
And I want to get to, because you've written extensively about how capitalism needs to change and some of the things that we should be thinking about and doing, and I want to definitely get to that a little bit later on. But I am curious right now, I mean, just from a practical level, do you think that we're headed into a global depression?
Yes, but I want to be careful about what I use the word, like to be
Right,
technical.
absolutely.
The word is an evocative word, and it
Sure.
could be scary and so on. So what do you mean by a depression? Okay. Something like happened in the 1930s. So just to repeat, 1929 to 1932, there was a fall in the economy and a very double-digit unemployment rates and a magnitude of fall in the economy like about 10%. Do I think we're in that? Yes. How was that dealt with? 1933. What they did is they printed a lot of money. And the government came out with the same type of programs that we're having now. Yes, okay, same thing. Zero interest rates hit zero. Same thing. Okay, same dynamics. And then there is that money causes an expansion from that point. How long does it take for the stock market to exceed its highs? Or how long does it take for the economy to exceed its former highs? A long time. Okay, do I think that's what we're in? Yes, that's what we're in. We've seen that happen repeatedly in history. So many, many times. It's just the most recent one. And there's a structure to that. So yes, this is not a recession. This is a breakdown, an operation that I'm just describing in terms of how it's dealt with, the production of money and credit, and all of that. That's what we're in.
And so you've talked about there's sort of four levers to recovery after a depression: cutting spending, also known as austerity, debt restructuring or forgiveness, redistribution of wealth through taxes potentially, and printing of money. Some of these things you've mentioned. Will those things get us out of this situation, since, as you feel it's happened before? But how would you think about balancing these tools right now?
Yeah, those are the tools since eternity, basically, since recorded history. Those are the ones that operated. And I think what you're going to see is a combination you're seeing of printing money and redistribution. And I think it'll last. These things happen pretty quickly. They last maybe a couple of 3 years in terms of that process. And then you have a rebuilding, and they're dealt with creativity. The greatest force through time is inventiveness, human inventiveness, adaptability. So you're going to see these restructurings happen, and you're going to see the kind of inventiveness that you just saw from Marco, okay? And it's the power of that adaptation that is the greatest power. I did a study, which is on LinkedIn if anyone wants to see it. And it goes back 500 years. And it shows real GDP. In other words, the economic activity going back there. And there's a line. And you don't see these depressions, as we're calling them, even on that line. They barely wiggles. When you go into it and you look at that piece, that's what it looks like. GDP falls 10%, unemployment goes up, and it passes. And because the greatest force is the force of adaptation and inventiveness if we can operate well together. So that's what I think it's going to look like over this period of time. It'll pass. The world will be very different. There'll be a new world order. But it will pass and will be inventive, because what we're dealing with now is just money and credit. Money and credit is just digital. I mean, there is real goods, services, those are real, but everything else is just accounting. And so when you change the digits and you work those things out and you work yourself through, that takes, a couple of years at most, kind of, and then you come back into a restructured environment. And it could be said that it is really healthy in many ways, because it is a stress test. Because if you look at history, people have gotten, sometimes they get weaker, or they're not prepared to, in many ways. Weaker in terms of maybe they don't build enough savings and they operate that, or maybe they emphasize luxuries over necessities. It's a reorienting type of experience that in many ways makes us healthy, even appreciating the basics of life.
Ray, just popping in here with a couple of questions from our online audience. I mean, the main question early on was just how difficult do you think the days ahead are for the economy? And you've answered that very vigorously, like using that word depression. That's a very strong word, and it's. Tell me if I have this right. It feels to me like what you just said there is stronger than most people in the market seem to believe. The market is behaving as if, we've had the bad news and it sort of kind of wants to come back. And a lot of people seem to think that within, I don't know, a year, we'll be back where you are. You're saying, no, it's going to take longer. Does that imply that there is basically a sort of some systemic shocks that the market hasn't yet fully seen, perhaps to do with the inability of some players to handle the extreme levels of debt that are piling up right now as people can't work?
Yeah, I can't speak for what everybody's thinking out there. The markets are off depending on what market and depending on what country you're in. Something in the vicinity of 25 to 45 or 50%, depending what currency you're managing in. And so if you're talking about emerging markets, they're worse because they're not going to get as much and so on. I can describe what I see, okay? We see something like $20 trillion of losses. Okay, we see, so if you work that through and you say you don't have money and you don't have credit, your business can fail. You know this, we see this all around us. So there can be failures when there can't be payments. And so the question is who gets what check to make those payments and get past it. But we're going to have a giant restructuring of the IOUs, and we're going to work out when hospitals can go broke, because this is terribly costly for hospitals, and they will not fully recover their losses. Hospitals will go broke, even though we know that they need them. So when you have to go entity by entity through this, and then you'll go through the process of who will pay. So this is not, some people mistake this as there is a virus, and the virus may come and go. Okay, maybe we never see it again. I don't think that's likely, but I mean, the people who tell me say, but who knows? But if it never came back again, there will be those who are broke and who will have loss of income. We're going to change how we operate in a way. The supply lines are going to change. In other words, self-sufficiency. What is self-sufficiency now going to mean? Do we have enough of this and that? We're going to restructure our economy and restructure the financial system in ways that mean we are not going to go back to the way it was.
So do you see systemic threats to the financial industry as great or greater than happened in 2008?
Yeah, this is bigger than what happened in 2008. I'll distinguish it. In 2008, we had banks. It's the same thing, meaning you have a certain amount of leverage, things go down. Too much leverage means you're broke in accounting terms. So then you look around and you say, who are the systemically important entities that you don't want to go broke? Because do you want to lose those banks at this time? And then you can make up money and make up credit, and you can keep them alive in some way. And you did it with banks, and through the banks, there were the mortgages, and that's what it looked like. This is more complex than that, because there are the banks, and then there are all of those that are beyond banks. All of the little businesses, all of those in all the different places that are beyond it. And it's a bigger crisis, and we have a less effective monetary policy because interest rates declines have reached their limit, and just buying financial assets by the central bank and buying the normal financial assets won't work. They have to buy the debt of the government, and the government or the many governments have to be effective in getting buying power and production to those who need it around the world.
I'm going to ask one last question, and then I'll be back at the end of the hour. Sorry, it's be back to you. But though, given how bleak that is, people are asking what kinds of industries, organizations, companies have the best prospects of thriving going forward.
Well, that's the beauty of it. There are two types basically. There are those that are stable meat and potatoes, not leveraged kind of companies, the Campbell soup equivalent, like everybody's going to use them all time kind of thing. And then there are the innovators. The innovators, like we're talking about Marco, you had Marco on before. And that new innovation, those who can adapt well and innovate well and don't have balance sheet problems. In other words, they have strong balance sheets, so they're going to be able to play the game without having that. They will be great winners. And so there's always new inventions, new creativity. That is the new adaptation that becomes a company and an entrepreneur. And they're going to do great, plus the stuff that we're always going to need. Those are the things that are going to do great.
Thank you, Ray. Ori.
Thank you, Chris. So I guess I'd like to stay with the market for a minute. Obviously, it's something that interests so many people, and the state of the market doesn't always correlate with what's going on in the economy. And the market and its players have changed so much over the past, 70 years or so, 70, 90 years. So many more algorithms and machines and passive investing. And how do you think that sort of affects how the market is behaving right now, how it's going to recover over the next, few years as the economy recovers?
The basic fundamentals of money, credit, crisis, who has what income, who has what expenses, who has what balance sheet, and how do we deal with money and credit. Those things which people often lose sight of because they happen only once in one's lifetime. This period, you have to go back to the 1930s as the last period. Those fundamentals of what a bank is and the associated process have existed all through time. Then it's like technology changes, technology evolves, and so the capacity to take one's thinking and to put them in algorithms. We've been doing this for 25 years. The way we operate is to take a principle, how would I deal with that situation, and write it down, put it into an algorithm, and then because the capacity to think has been radically enhanced because the human mind has a capacity problem. It's unique in inventing, but it can only process so much at so time. So when worked in partnership with the computer, which has the capacity to take that thinking and replicate it and do all of that leverage thinking and think in an advanced way, that is the advancement of our time. And so you're seeing that. So when you think algorithmic, it's, you got to break it down as to what it is. Is it sensible cause-effect relationships that are being dealt with? It all comes back to, do you have understanding, and are you successfully betting on a cause-effect relationship? Because that's the only way you're going to make money. So, but the computer can do it and process that thing in a much more advanced way. So that's what's going on. There will be people who will make the mistake of just applying machine learning to the markets. And that won't work because of certain things. I guess I should explain because you asked. So on algorithmic decision making, there are two ways you can get your algorithm. You can specify the instruction to the computer and have it follow that, and that'll enable your thinking. Or you can have the algorithm come from putting a lot of data into the computer and asking computer, what would you do and what's your algorithm? The key difference between those is, do you have understanding of the cause-effect relationships? You must have understanding of the cause-effect relationships to know what to believe in, because you can't always get that in your sample size. For example, what's happening now, you could not have run your computer and have it in your sample size, because you would have to go back to the 1930s to have an analogous period. So it is how you do that, but the capacity to learn, to invent, and to get, that leverage in decision making is greater than ever before. And that's the power of our time. Some will do it well, some will do it poorly, but it really comes down to, do you have the understanding of those cause-effect relationships so that you know how to place the right bet?
But that's very different from the passive investment market, which is such a huge part of it now. And that's where most people, the average person has their money. And I know that everything's changing day to day, but I also know that everyone's going to have this question on their mind. So I'm going to ask you, I'm not going to ask for specific investment advice, but everyone's thinking about their 401ks. Do you have any general thoughts about how people should approach this time period with that kind of money?
Yeah. First of all, an investor must understand that they probably will not be able to play the game well. They probably will not be able to decide how to move in and out of things. In order to be successful in the markets is more difficult than getting a gold medal in the Olympics. You wouldn't think about competing in the Olympics, but everybody thinks they can compete in the markets. But there's more money competing. It's like a zero-sum game, and there's more money doing it. And the worst thing you could do is think you can time all of these movements. I guarantee you the game's a tough game to time. We put hundreds of millions of dollars into the game every year, and it's tough. So what the individual investor needs to do is know how to diversify well. So the word that I would know how to diversify well and in a balanced way. The greatest mistake of all investors is to think that what has done well lately is a better investment rather than more expensive. And and what has done worse lately is the worst investment, get me out of it, rather than it's cheap. And unless you know how to deal with the differences of those, which most people don't, they're going to be in trouble. So understand that wealth, total amount of wealth in the world, essentially doesn't change very much, okay? And that one thing goes up, another thing goes down. And to know how to diversify it in asset classes, to diversify it in countries, to diversify it in currencies, to know how to diversify that well so that you have wealth diversification is important. Do not think that cash is a safe investment. Most people think, look, I just want safety, and those bonds aren't giving me an interest rate and so on, so where do I get safe? Cash is a seductive investment because it doesn't have as much volatility, but it taxes you in your buying power about 2% a year. And so, so cash is almost always the worst investment. So you have to think about that. You should think a little bit unconventionally. Do you have a little bit of gold? Do you have a little bit of asset in case this monetary system breaks down and money's redefined? Do you have a little bit of that? I can't get into all the different ways that one can diversify well. I try to convey those things in my books or on posts on LinkedIn particularly. But I would say diversify well, be humble, don't market time, and be conscious of the dangers of cash.
Right, that's great advice. I want to ask one more sort of big picture question before we sort of get into how we should fix capitalism. We can talk about that in a minute, tackle that one. But I have been reading your series on LinkedIn, The Changing World Order. It's really fascinating. I'm curious what you think about, there's been sort of this retreat from globalization as something we should all get behind. And I'm curious what you think about that in terms of our recovery. This seems like something that is going to require a coordinated effort, you know, financially, spiritually, in so many different ways. If we retreat from globalization right now, does that make everything harder going forward?
If we retreat from globalization, which we certainly will do, it will certainly make things very hard. And so we get down to the comparing idealism with reality. So when you say globalization and who will write what checks to people in countries that will be outside of their domain? And there are large numbers of those people. You know, my wife and I are trying to help people in Connecticut. And, you know, I can rattle off all that is and what a job that is, and so on. And so when you have Congresses and presidents, and they start to say, who will we help? And how will that be? And what will that mean? It gets down to real practical questions. And the reality is a lot of those people won't be helped. And then you'll deal with how will they behave for each other? Are one country's vulnerabilities another country's opportunities? In such times, this is the case because, Graham Allison wrote a book about the Thucydides trap, and he remind us, over the last 500 years, there have been 16 countries in which there's been a rivalry of an empire challenging another. In 12 of those cases, there have been wars, because at the end of the day, there's not even a global legal system. Power is what is the currency of that. So when you get into how do you resolve a dispute as to who gets what, that becomes a very complicated question. So I'm a globalist. I mean, meaning I have a dream and a wish that the best of the best can operate together and work together for that common good and so on. But it's dying because we're in an interconnected, fragmented world. The fragmentation of this, can I depend on somebody else to give me something I need? Or can I depend on them not taking advantage of me? No, you can't make those dependencies anymore. And that exists within countries as well as between countries.
Yeah, I mean, it seems like, you talk about productivity and the importance of productivity for us all to have a better life. And it just seems like on a global level, the same should hold true. If we're all focused on being more productive together and in that interconnected way, we'll all do better, as opposed to kind of hoarding one asset or one set of resources.
You're certainly true. That has always been true, but never more true than today. And at the same time, read history and understand the mechanics and the issues and the challenges of this. This separation began before we had this isolation of the United States relative to the rest of the world. This deglobalization began before we had this that fosters more of it, right? And it happened for reasons, okay? So don't overlook those reasons, and don't overlook the reading of history just because we wish it can happen. If you want to wish it happens, everything is all dependent on the behavior of those who have their hands on the levers of power. I would tell you, like, for example, right now, I've been going to China for a long time, and the Chinese, in many ways, are helping, in many ways, things that are needed in this crisis and all that. To even say that is a politically challenging thing, okay? because we're in a world that is so fragmented that even to publicly say thank you, and thank you to many people and many companies, it's almost dangerous to say thank you to those who are helping, because we're now in an environment in which there are enemies, and who is evil, and do you fall into that category? And so the history of these is there's demonizations of different people. Okay, now you must see it around you. It exists. And so how we come out of this will be how we behave with each other.
Yeah, that's such an important point. And I think all of us here would say thank you to, the different people helping out in this situation. We do need each other. I do want to get to this issue of capitalism, because when we talked a few days ago, you mentioned, and earlier in this conversation as well, how, this period of time we can emerge stronger and better than before. And about a year ago, you wrote a piece about how capitalism needs to be reformed, focused a lot on the wealth gap, the growing wealth gap, and the problems that that's causing. So what's our opportunity here? What changes can we make?
Well, what I was seeing was, do we want the outcomes that we're getting, that the system is producing? Do we have, what is our American dream? What is that? We're not even almost talking about that. When I was growing up, so again, I grew up, I was born 1949, right after the New World Order was created. New World Order was created in 1945. And I'm 45. And that was when there was a breakdown of the system, and then we had a New World Order. We didn't have as much debt. We came back for the war, and there was an environment of equal opportunity. And that notion of equal opportunity. And there was an American dream, and there was a harmony and a going through it together. And by the way, that's not a one-off. If you read histories, you see these periods of collapse and clash and fighting, followed by these periods of, you construct the balance sheets, you change the system, and then you begin a new system, and you come back and you work together. And then I'm seeing around me children in school and education systems in poor neighborhoods are sharing. They don't have adequate resources. There's no excuse. And so the idea that the profit system can accomplish everything is not right, because resource allocation goes to those who have the resource. And so throughout all history, you go back hundreds of years, you see that any system works for those who tend to control the system. So let's say we have a capitalist system, and we have entrepreneurs, and you acquire money and all that, and then working with those in government, and they have a symbiotic relationship, and it works well for them. So it's self-perpetuating, because the education of those who are those is better than the education of those who aren't those. So, for example, in our system, those in the top 40%, on average, spend 5 times as much money on their children's education than those who are in the bottom 60%. And so it's become self-perpetuating. And so when I look at that, I'm saying, I'm a capitalist. Please understand, I'm a capitalist. I believe in the system. I believe you can increase the size of the pie, and you could divide it well. And if we talk about how to do that effectively, we need to do it. But there becomes a time that there needs reforms, and those reforms have to create productivity. It doesn't mean just give money away. It means, how do you make those people productive so that they are also psychologically productive, as well as physically productive in producing output? You need to do that system. And so for reasons I wrote on that page, that post, it's on LinkedIn if people want it, that you need to restructure it. Now we are restructuring it, okay? It's the inevitable consequence of what we're doing here. We will come out of that. There's been a tremendous transfer of wealth, whether people realize it or not. through the production of all of that borrowed money and all of that producing of money, that is a big force. We will come out of here. And the thing we will talk about over the next couple of years, and probably sooner rather than later, is how we do that restructuring. And my worry now is the same as my worry then, whether that will be done in a civil, bipartisan way that will both increase the size of the pie and divide it well, rather than damage the economy because you lose productivity. There are certain things that are great investments. Education is a great investment. The more people you have that are well educated and you have equal education, the more people you're going to have who have a chance to compete with each other and raise that over a period of time. It's a hell of an investment. It will produce more productivity than it ever will cost if it's done well. But what happens is states and localities think of it as a budget item. So they look at expenses and they penny pinch on the education, because if you're in a rich town, your kids will get a good education. And if you're not, and a large percentage of the population is losing that. So that has to be engineered well so that they're productive as well as divide the pie well, and everybody believes that the system is fair. If we can get there, am I optimistic that we will get there? I don't know. I would say I'm 60-40 pessimistic that we'll be good enough with each other to do that. But there's that possibility. This is our test. This is our stress test.
Ray, it's there's so much interest in this question of how we emerge from this, whether it's genuinely possible to rebuild the economy in a way that's fairer. I just want to read one last question. This one's from my Twitter feed. Do you think that the current crisis is showing that low-paid and/or unskilled workers are what holds countries together, even more so than banks and hedge funds? And if so, as part of the rebuilding, can we build an economy that raises their interests higher?
The heroes are those kind of people. Okay, really. But it takes everyone. Okay, it takes the efficient allocation of resources for, as you probably have seen behind the scenes, we see those who control a lot of resources being able to make We're giving 60,000 computers to poor students so that they can learn. The difference between a rich and a poor student is having a computer and have the ability to learn. And I want to thank those who would be embarrassed and almost afraid to hear it, of how they contributed to that process. And at the same time, those other people who are every day serving in so many ways. So it's good character. And is that like when the people came back from war and they were the greatest generation, it's that type of character, and that brings our country together. But each has to recognize their roles in doing that. So there's a CEO, and then there's somebody who's really a great hero on the front lines, and they better damn work well together. So yeah. And then they have to have usefulness, and we've got to appreciate them. We have to establish just the reality, I think, that there is a level of basics, basic education, basic health care, basics that you cannot fall below. Okay? Otherwise, when you go below that level, there is no opportunity, and it actually, the costliness of it in the form of crimes and incarceration. Like to bring it personal, our mission is to help high school kids who are drop out of high school and have jobs, to get them in high school and through that in jobs. And we believe that we can do that and save a lot of money, because the average rate of cost of incarceration, depending, it goes from about $40,000 a year up to $120,000 a year, depending on the form. And if you get them in and move them into a job, you're going to save a lot of money, and we could do that cost effectively. But philanthropists can't do this alone. The amount of money is enormous. So if our country did those kinds of things, I think it'd be great.
Wow, thank you for that, Ray. Corey, what do you think? You got any other questions there before we wrap up?
No, I think we're good. I mean, I think we're going to get through it, I guess, is what we're saying. But we also have an opportunity here to make some changes and do better and emerge stronger. And to, as you said, take a look at things and the structures that we have in place and see where we can improve. But it's going to take a collective action and cooperation.
Yeah, Ray, I'm definitely inspired by the actions that you're taking as a philanthropist in this moment, and some of your peers. You know, like there are amazing stories out there. I was really struck by Jack Dorsey's announcement yesterday of his huge philanthropic contribution, and I mean that's awesome. But equally important,
but it's not nearly enough.
Right. And I'm kind of dismayed in a way to hear you say that you're 60-40 leaning pessimistic. Like, it feels like your voice in these conversations that are going on in the corridors of power and in you know, where the big money is, around whether this turns into fundamentally cooperation between countries and between companies and between, you know, big money controllers, or whether it turns into a fist fight is so important. And you know, hearing you talk about the gratitude we should be feeling towards some aspects, let's say, of what China has done, like the extent, do you find yourself in conversations like raising this, trying to take the view that no, you're needlessly sparking friction here, take a more generous view? Because it feels to me like there's so much at stake between how many people are trying to nudge that type of conversation versus the hostile, fearful conversation.
I think there's a general mistaken belief. I communicate a lot with the people that you're saying, people in positions of power, whether they're both in government or other places and so on, and have the thing. I think what you basically have to realize is that very few people are making decisions based on the quality of the argument, that most people most of those in the have a particular, are in a war of some kind or have a particular objective, and that the information that comes out, even in the media, you know, you could almost see which side each media outlook or each person is on. How many people do you really believe don't have a side? Almost everybody has, they're on one side or another side. And the idea of being able to see things from both sides and come together is, in this time and through history, perceived as almost being weak or a threat, because you got to get on one side or the other side and so on. And so it's not easy to just say out. I'm like all the people and China, and an example, I would say, thank you very much. You know how many respirators and masks and all these things that have come, but almost that's politically challenging, because there'll be people out there and threatening. Why am I doing this? And people will be out there and they will say, okay, he's a China lover or he's an enemy. He goes on the other side, because there will be people on the other sides and those people. And so I think I'll turn to you, Chris. You have a forum. Bring in the other sides, okay? Bring in those that are those who, let's say, have the most offensive policies that you think that are in positions of power, and have that together so that you can have thoughtful disagreement. And like I'm a believer in thoughtful disagreement, open, thoughtful disagreement, to try to get at the right answer and have collectiveness. But it isn't easy in this world.
Oh, well, that's a good challenge to us. And I'm also a believer in thoughtless disagreement. I think, Corey, we're passionate disbelievers in the spreading of irrational hatred, like instinctual irrational hatred. And I feel like the stakes are so high right now that
But will you fight for that? In other words, will when somebody is going to punch back and because this is what's needed. If somebody's going to punch back because you're saying something that's true and controversial, that'll be the test. Can you punch back for collective, decision making, common decision making, and then punch back?
I'm not going to say punch. I'm going to say fight back. Absolutely.
Okay, fight back.
Every fiber we have weak. If it means that we look weak or we're a threat, so damn well be it. Because this is the moment. I mean, everyone is impacting everyone else. We have a shot to nudge each other to be our better selves and to look at the stories of inspiration, the stories of humans reaching out to humans, of companies doing incredible things, letting go of the profit motive for a moment, of countries trying to help each other. There are stories about that. I think we need to amplify some of those stories more. And we're certainly down to do that. We're trying to do that every day. And Ray, I loved hearing you talk about some of the good things that China's doing and all the rest of it. Thank you for your voice and for spending this time and for being, honest and vigorous with us. And thank you everyone for listening.
I appreciate
a big damn deal. If you're listening, it sounded like you just got a warning that this could be a multi-year recession, depression. That's scary, and more than ever, we need to be in this together, as we've said again and again. So,
in conclusion, I know we're wrapping up. Yes, I believe this is a defining moment. We will get through it fine. We will be restructured in important ways. So that's fine. And thank you for sharing ideas worth considering.
Thank you, Ray. Thanks so much, everyone, for listening. Corey, do we want to? I mean, we've still got more days to the week. There's an amazing program tomorrow where we're taking a much more global look there that I'm super excited about. We have a report from the head of LabourNet, which is an organization in India, looking at mobile workers who just are facing this horrific situation right now where they're having to, in the lockdown, having to maybe walk home hundreds of miles or face police action. We've got a report right from the front lines there as to what that's like, and a country with a very different set of trade-offs they're having to make between lockdown and giving the most impoverished a chance. And then a wide-ranging discussion with Fareed Zakaria, who has this global view. You will have seen him on CNN. He's got this very broad-ranging global view as to how to think about this thing and to compare the different responses of different countries. I think it's going to be an amazing conversation. I urge you to come back for that.
It's so amazing. We were talking about this in a meeting this morning. This is a crisis that the whole world is going through together, and I think that's what's so unusual about it. And there's just so much to dig into, so much to learn about how it's affecting everybody in different ways. So I'm glad we're continuing.
Thank you, everyone. Thank you, Ray. And you can see a recording of this if you didn't miss the whole thing by going, basically, I think it's to go.com/TEDconnect, go.com/TEDconnects. And if you want to look at Ray's work on this, just Google Ray Dalio LinkedIn, and there's a whole series of resources there. That's Dalio with one. Ray, thank you so much for this. This was really, really, really interesting. Thank you so much. Thanks all.
Thank you.